Hi, I'm David Hall. I'm a chartered accountant with Flame Woolsey. I have over 20 years experience both in public practice and private industry. For the last 6 years at Flame Woolsey, I've worked almost exclusively with physicians. It's important for folks to really have a qualified team to support them. Doctors are busy and they don't really always have the time to focus on, various accounting and tax issues. Those issues change quite frequently, perhaps annually. And it's difficult for a doctor to keep up with that, or if not impossible. Doctors are among the top 10% of income earners in the country. So if you miss a rule change or do something incorrectly, it can have a significant impact on your taxes. So again, by having a qualified professional assist you, you can minimize your overall taxes and maximize the amount of take-home pay that you have. So let's talk about incorporation. For most doctors, it's a very big decision, and there are many factors that you need to consider. That's where the advice of a qualified accountant can really help you get through that process. There are many benefits, including tax savings, tax deferral, and the ability to income split with family members that can save a significant amount of tax each year. Then really you want to consider the cost associated with incorporating. There are some upfront fees and annual fees to keep the companies going. And also, it's more complicated for folks in that you have two entities now to file tax returns for each year. But for most people, on the whole, it ends up being a net benefit. In order to make the decision to incorporate, you first really need to understand what are my choices. So you can have an unincorporated practice, or you can incorporate your practice and have it inside a company. For an unincorporated physician, what you'll see sometimes is that person is an employee, and so they would receive a salary from the hospital. Taxes and CPP and EI would be deducted, and at the end of the year you'd get a T4 slip and report that on your personal tax return. The unincorporated physician who is an employee is not all that common these days, and what you end up seeing is folks who are really self-employed and are carrying on a practice that way. So it would be a sole proprietorship, which basically means that I'm carrying on a business in my own personal name. If you do carry on a sole proprietorship, it's important to note that I'll receive my fee for service, whether it's from MSI or some other private pay or insurance. And also I'll have to pay my expenses associated with my practice. So really I receive fees, I pay expenses, and then what's left over is the income that I have to pay my income taxes on. So you would report that income on your personal return, and you'd pay CPP on that and personal income taxes. So again, it's very similar to an employee, but it's again, you running your own business, and so there's no one else withholding taxes from you. If you did decide to incorporate, then we introduce a company. So now all of the fees are received by the company, and the company will pay the expenses. From a tax perspective, the company has net income, and the company at that point will pay taxes. In order for the company to get money to you, there are two choices to do that. For a doctor, if you incorporate, the doctor is both an employee and the owner of the company. So you can decide whatever mix of compensation you would like to take in terms of salary or dividends each year. Any money that you do receive from the company, whether it be a salary or a dividend, is taxed on your personal return each year. A physician that is carrying on a practice, whether it be incorporated or unincorporated, needs to know how the business is doing. There are two key statements that the accountants would prepare for a physician to show that to them. One of them being the income statement. That would cover a period of, say, a year, and it would show the fee revenue that the company was able to bill or any other sources of revenue. And would also show the expenses that the company had to pay to earn that revenue. So for example, if a physician had an admin assistant that he had to pay a salary to, or to pay rent, or insurance or CMPA, that kind of thing, we would show those expenses, and the income statement would deduct those expenses from revenue, and it would show net income of the business, whether it be incorporated or unincorporated. The other key statement that is prepared for business owners is the balance sheet. And the balance sheet shows the things that the company owns at a point in time. So it's more of a snapshot So it would show the company's assets, whether it be cash in the bank or investments or equipment, and it would give you some idea where those assets came from and how they were funded. So for example, if you went out and bought an expensive piece of equipment and obtained a bank loan to show that, the balance sheet would show something called liabilities. So those are amounts owing to creditors. And so, it shows the source of funds, where the assets came from. The other component of a balance sheet is something called the shareholders' equity or owner's equity. And that's money that the business has generated and has been retained by the company. Not only do financial statements provide a means of evaluating the past performance of a business, at their most basic level as well, they'd also be used to complete a tax return. So whether you're incorporated or unincorporated, you still need to prepare financial statements to be able to report your net income on a personal or corporate tax return. In addition to that, financial statements can help you make a future-oriented decision. So for example, as a doctor, you report net income and you might be applying for disability insurance. So the insurer will want to see your financial statements to assist them and yourself in deciding on the amount of disability insurance that you'd want to carry. Now I'd like to talk to you about the advantages of incorporating, and there are 4 key ones that most people would realize. The first being tax savings. So by incorporating and paying corporate tax and then paying tax on a dividend that you withdraw from the company, the overall tax rate is about 4% less than you would pay if you had earned the income directly as an unincorporated physician. The next big savings that most people realize is income splitting. So as an unincorporated physician, there is some opportunity to income split, but it's really quite limited into basically paying a salary to a spouse or a child. And the reason that you're limited is that the salary has to be commensurate with the level of activity of the person, and it can't exceed what you would pay as a salary to an unrelated employee. Through an incorporated practice, you would give shares to family members, and basically what you could do then is pay dividends to family members, and you aren't subject to the same restrictions. So you could really take income and split it any way that you want. So again, that's probably a very significant tax savings for most people. For example, if you had $200,000 of dividends and you paid that out to yourself, the taxes on that would be about $48,000 or $49,000. If you were able to take that income and give half to yourself and half to a spouse, the total taxes would be about $32,000. So again, it's pretty significant. And the next benefit that most people would realize is something called a tax deferral. And so what happens there is you would earn revenue from practicing medicine and pay expenses. Then if you're incorporated, the company is going to pay income taxes at about 15%. You won't pay any other tax until you go to take that money out as a dividend, let's say. So really, if I'm able to earn income and keep it in a company, I can pay a low rate of corporate tax and then keep the personal tax on a dividend and not pay that until I eventually take a dividend from the company. So what I can do with that tax savings is invest it and have it grow over the course of my career. And really, that will help fund a pool of assets that will generate income for my retirement. The final benefit of incorporating is that it will give you some level of creditor protection. So what happens is a physician who is practicing medicine and for some reason is sued for malpractice, incorporating doesn't shield your personal assets from a liability in that case. So what you can do in your corporate structure is introduce a family trust and a holding company, and through a more complex structure, it'll give you some level of protection of your assets held within a holding company. Should you decide to incorporate, all of the income earned by the company is in the company's bank account, and we need to be able to pay the physician to fund lifestyle expenses. In developing a compensation plan, we recognize that a physician is both an employee and an owner of the company, and what we'll do is pay a mixture of salary and dividends to the physician or family members to minimize your family's overall taxes. The key difference between salary and dividends are that a salary is deducted by the company and it's paid to the physician, who would then basically pay all of the income tax. So a salary will reduce the company's income tax bill, but the physician will then pay taxes on the salary. Physician will also pay CPP and both the employee and employer portion, and that will generate Canada pension for folks when they retire. And also paying a salary will enable a physician to contribute to an RRSP each year. The salary would be reported on your personal tax return, and the company would file a T4 slip so that you could prepare your return. If you decide to take dividends, then the company will pay its corporate income taxes, and then it will pay a dividend out to the physician and his or her family members. The dividends would then be taxed on your personal tax returns. Dividends are paid to the shareholders of a company, so it could be the physician or other family members who are over the age of 18. The dividends are reported on the family members' personal tax returns, who would then pay income tax on dividends. It's important to note that when you do decide to take dividends from the company as opposed to a salary, dividends don't give rise to Canada Pension Plan contributions, nor will you receive a Canada Pension Plan when you eventually retire. The other key difference with the dividend is that it doesn't generate RRSP contribution room. So for most folks who are taking dividends through their primary means of compensation, the goal would be to retain funds in your corporation and save for your retirement within your corporate structure. The decision on how to compensate a physician can really change from year to year and from physician to physician. So we really do want to sit down with all of our clients annually and get to know what's happening in their personal lives, so that we can identify how much money they do want to take out of the company and the best way to do it. The decision might change one year to the next if tax rates change. So we may want to change our compensation mix to be able to minimize the overall tax bill of the physician and his family. For a doctor that's considering incorporation, we like to start the process off with a fairly lengthy meeting so that we can understand your personal situation and again, make the right decision for you, whether it's best to incorporate or not. Usually by the end of the meeting, most people decide that the benefits do outweigh the costs associated with it, and we would then decide to proceed. The process would then involve us providing instructions to a lawyer, and the lawyer would then go ahead and register the company name with the Registry of Joint Stocks, and also get approval for the name from the College of Physicians. The lawyer would then also arrange for a license for the company, and once that's all been prepared, the lawyer would have the physician come in and sign all of the necessary documents to actually incorporate the company. What we normally tell people is, after you meet with the lawyer, you'd want to proceed to the bank, open up a bank account in the company's name, because one of the first things we want to do is to be able to start having fees and other revenues deposited into the company and have the company start to pay for its expenses. The next step after that, at our firm anyway, is that we invite the physician to come back about a month or 6 weeks after incorporation. Once you've got a deposit or two and I'm ready now to pay myself a salary or dividend. And what we really want to do is get people back so that they understand the requirements for record keeping for the company. And also, we want to cover again some of the key concepts of incorporation and revisit the compensation plan to make sure that everything is still appropriate. So from there, we have the physician proceed with paying dividends or salary. And also, one of the key things we want to do is make sure people understand that there will be a tax bill for both the company and the physician and family members at the end of the year. And we want to quantify as best we can what those taxes will be, so that it's not a surprise for people come tax time, that they recognize I'll have a tax bill at the end of April, and here's what we think it is, so you can start to save and set that money aside. We've talked about the benefits of incorporating, and in order to make the right decision, we also really want people to understand the cost. The primary cost would be professional fees to create the corporate structure. I think for most people that go with, say, just an incorporated medical practice, then no family trust or holding company, the fees would be in the range of $5,000. Should you have somebody that's concerned about creditor protection and they want something more that gives you better protection against loss, you'd want to introduce a holding company and a family trust. If you were to do that initially, the fees for the lawyers and the accountants would be about $9,000. The other cost associated with incorporating is that now I have to file tax returns and various other tax filings for the company. So there's some incremental ongoing fees for that. And for most people, $2,000 per year would be a reasonable estimate of the extra fees that you would incur. And finally, the structure is somewhat more complicated than if somebody were unincorporated. So by that I mean now we have a company with its own bank account, and in order for a physician to access money, they need to take an extra step to pay themselves a salary or a dividend. But generally we find for most people the tax savings from income splitting and lower tax rates and the tax deferral far outweigh the professional fees associated with incorporating a company. For physicians looking to incorporate, it's important to remember that over the course of your career, income taxes will be your single biggest expenditure. It'll be more than your mortgage, more than your kids' education, and more than your cars. So any decision that you can take to minimize your overall taxes will have a very significant impact on your financial well-being in the future.